You might think of mortgage brokers only for getting the best home loan rates, but they've got a lot more knowledge and value to offer than that. Loans for construction and renovation are definitely not one size fits all. Today, we move on to the next step in the renovate or sell journey, borrowing finance. When it comes to construction projects, everyone has different objectives. Large projects, small projects, owner-builder, licensed builder, even modular or relocated homes, and that's just the beginning. Not all banks will finance everything because there's different levels of risk, so it's important to find out what finance is available for your project ideas before you go too far. In the Renovation Collaborative podcasts, I interview industry experts and find out the latest practical info to help you renovate smarter. My name is Stephanie Skyring. I'm an Australian architect with 20 plus years of experience helping people create better, more environmental homes on any budget. I'll be talking to highly respected mortgage broker Richard Jefferies from Newbridge Home Loans in Brisbane. Good morning, Richard, and welcome to the Renovation Collaborative on the Tools podcast.
Thank you, Stephanie. Great to be here.
So, people often think of mortgage brokers simply about getting the best rates for finance, but I know that you've got so much more information that you can offer to really help people get the best results. What is the benefit of going to speak to a mortgage broker rather than just going to the bank that you deal with all the time?
Well, I think the biggest advantage a mortgage broker has is they're going to give you options. Most mortgage brokers have at least 30 banks and mortgage lenders they work with. If you go directly to your bank, you're only getting one option. Now, that's going to be important when it comes to the approval part because different banks will have different criteria and what they can lend you will definitely differ. And then it will also impact the interest rate you get. One option, you're not going to know if you're only getting one option how that compares with the rest of the market.
You've got no context,
That's
do you?
That's right, yeah. So I think it's incredibly important to understand what are other banks offering for what you're after.
Your company, Newbridge Home Loans, you talk about your 5 L's of lending, which is really informative and such a clear way of capturing what a mortgage broker can do to help. Could you tell us what they are in just quickly, and then we'll go through each one of them one by one and you can explain them in more detail?
Yeah, definitely. We came up with the 5 L's to try and simplify the process. We find that when people are applying for a home loan, it's something they're not doing regularly, so it can be really foreign, some of the concepts. So with the 5 L's, the first L is simply your level.
Yep.
So we want to understand how much can you borrow, what is it going to cost you, what are you capable of doing, be it renovation, etc. The next L is loan types. So what type of loan do you need for what you're looking to do? Thirdly, it's lender. So which bank, once we get the structure right and how much you can borrow, then we can go and shop around and go, okay, which bank is going to be best to work with? Step 4, we're then lodging your application. So we're putting in the paperwork, getting the approval in place. And step 5 is life of the loan. And that's all about reviewing the interest rate on an ongoing basis.
That's fantastic. So let's jump into those and find out what each of them are all about. So the first one you start with is level. So tell us more about level, because I know that with clients in architecture, like one of the first things I say to them as part of your working out your design brief, budget is a really big part of the design brief. So it's all about how much, what are the constraints we're working with, how much money are we working with here? So tell us more about level.
Yeah. So level is broken down into 3 parts, level. The first being your equity or deposit. So the first part of your level is understanding, and what the banks will want to understand is what amount of equity do you already have in the home? And that'll dictate how much you can access to renovate. After that, they'll look at your borrowing power. So that's the next part. So if you are taking on more debt, what can you afford in the way of repayments increasing? And that'll be looked at based on your income, your household income, and your expenses. So any other debts you've got and number of children in the home, things like that. And finally, the final part to your level is your stability and conduct. And when we talk about that, we're talking about how long you've been in your job, but also your credit score too. The banks will look at that. So we want to satisfy the bank's criteria in all 3 of those areas. It's no good having heaps of equity but no income, for example.
So You've mentioned about getting equity out of the land or the existing property, and that's fantastic if you've got that. But what about potentially first home buyers or people who aren't in the industry yet? I've heard that you can get someone to go guarantor for you. How does that work?
Yeah, obviously becoming a lot more difficult for first home buyers to get into the market. And the hardest part is usually saving the deposit.
Yes.
Trying to save 20% on a $800,000 home would take several years.
And that's the base deposit that you need, really, is it? That what you're aiming to achieve?
Most people would suggest to aim for 20%. You don't need that much. You can get away with 5%. To get into the market for first home buyers, if you've got 5% and the property's under $700,000, there is a government scheme called the First Home Loan Deposit Scheme. That was brought in by the Morrison government, and what the government does is they will guarantee your loan so you don't have to pay mortgage insurance. So think under $700,000 in Brisbane.
Yep.
I've got 5%. I can have the mortgage insurance waived from a first home buyer because of that scheme. There are certain lenders you need to go with, but it is a great scheme. It's going to save you at least $15,000 in that case.
That's a great scheme, but thinking about $700,000, it depends where you're going to buy. And I certainly know there's a large, portion of around Australia that's fine. However, if you're in an area that is over that, which I know obviously a lot of inner Brisbane is, how does that work if someone's going guarantor? And are people doing that a lot, or how does that work?
It is becoming more popular, definitely. So guarantor simply means that the bank will take security over a family member's property who has really good equity, and that will then reduce their requirements on the borrower to put in a deposit. So if you're using a guarantor, often you don't actually need a deposit at all.
Oh, okay.
Yeah. So for people who are fortunate enough with their parents or other family members have really good equity, the bank will take a lien or take that property as security so that they've got more of a buffer. So if the borrower doesn't pay, they will recoup those funds from the sale of that house. If they're short and they're still owed money, they can go back to the guarantor and seek those funds from the guarantor.
And you're seeing a rise in that?
We are because of properties being priced at what they are. Your parents, usually, if it is your parents, usually most banks want them to be working. They don't want to be doing it for pensioners.
Oh, or retirees.
Correct.
Yeah.
Unless
they've got investments and things.
Yeah, unless they've got investments and they're what they would describe as high net wealth.
Yeah.
They would prefer to do it over an investment property. So if your parents have got an investment property, that would be the preference.
Oh, over the primary residence.
Yeah, because the banks, as they say to us, we don't want to be on a current affair because we
took away their family home.
We kicked out a couple from their family home.
Yeah, interesting. It's tough times. It's really tough times to get into the market. So let's move on to your second L, which is loan type. Can you tell us a little bit more about that? Because there's so many different types, aren't there, depending on what you're going to do?
There certainly are, and probably the easiest place to start when you're talking about different loan types is whether you look at a fixed interest rate or a variable.
Yeah.
And that's actually really important with renovating because what a lot of people wouldn't realise is that with a fixed rate, you're very much locked in. Most banks won't let you take a fixed rate if you're looking to renovate.
Yes.
There's going to be drawdowns or there's going to be, cash required at different times. A fixed rate is just not really going to work in those circumstances and usually not even going to be available.
Yes.
So a variable rate would usually be what someone would need to go with if they're going to renovate or build. But if they've got an existing fixed rate, it's important to know that you're probably best just to keep that where it is and take out a new variable loan for the renovation finance you require.
Oh, okay. And why is that?
Well, if you go and let's look at it at the moment. A lot of people have fixed several years ago around 2%.
Yeah, it's coming to the end of it.
It is. And rates now are in the 6s.
Yes.
So if we had someone come and approach us and say, I'm on this great fixed rate, I've still got another few months to run, how do I go about borrowing an extra $200,000 for renovation? We'd say, look, don't touch that fixed rate. We don't want it to end any sooner than it's going to, because it's on such a great interest rate. Let's just borrow the extra as a separate facility on a variable rate. It's for renovation. The bank will be happy with that. And that way we keep that other money locked away at a nice low interest rate for as long as we can.
Something else that is also really important for, I know, renovation and new build clients to know about are the different types of loan, whether you're renovating or building or a large renovation or a small renovation. There's lots of information there that you can give us as well, isn't there?
Yeah, definitely. It's really important to understand that in the bank's eyes, what you're looking to do, is it going to be considered a construction loan or is it going to be looked at as what we would refer to as cash out or an equity loan? So a construction loan, if I start there, is usually when you have a builder involved and it's a really significant renovation. So think more than 100,000, usually more than 150. And there's going to be progress payments. So the builder's going to come in, they're going to complete the work in stages. They're going to invoice you for payment, maybe over 5 stages, 5 invoices.
They're over the stages of the contract.
Correct, correct. Lined up with
the construction contract with the builder. That's
exactly.
Right.
And each time you get one of those invoices, you'll need to sign it and send it to the bank for the bank to make the payment to the builder.
Right.
Yeah. So that'll usually it's over 5 stages. That's what we would call a significant or large renovation, major renovation. And the bank would look at that as a construction loan. Now, where that's important is they're going to, because they're controlling the funds that they're paying to the builder, they're happy to say, all right, well, when we do the valuation, we're actually going to value it on what this house is going to be worth when the renovation is completed. Okay, so that then allows you to have a higher valuation used and potentially borrow more. If we use really round numbers, you've got an existing property worth $1 million, you're doing a major renovation for $500,000. Usually the bank will get it valued on what it's going to be worth when that renovation's completed, and that might be $1.5 million. That's a rule of thumb. That's usually how it works, or something similar. So then all of a sudden you could borrow up to 80% of $1.5 million.
Ah, okay.
Okay.
Yeah.
As opposed to the bank going, well, your house at the moment's only worth $1 million. We're only going to lend you 80% of that, which is $800,000.
Right. So that only kicks in. Well, we'll find out if it only kicks in with relation to a construction loan.
Only relates to a construction loan, and the banks generally want to see that you're spending. Their criteria is it's usually more than $100,000 to be able to do a construction loan, and you must have a licensed builder involved.
And that construction contract in place so they can get those stages?
That's right, yeah. Because the bank isn't going to be confident or willing to just give you the money for those stages at each point. That you might want to head off to Vegas or do a trip somewhere instead of putting it into your home as you promised.
Yes.
Whereas they do have confidence and security in giving it to the builder, because obviously the builder has got to then go and pay his trades.
That's right. And so you mentioned a few things there that are interesting that I think we'll come across a bit later in these questions. And obviously at some point then the bank's going to see those construction drawings, and then they're going to make a valuation against those to make their own assessment about what that added value is. Is that correct?
That's right. They're actually going to get a third party, a valuation firm, to do that. So if you think some of the big ones are Heron Todd White or CB Richard Ellis, they're going to instruct one of those firms to take the building contract, the plans and specifications, and work out what's that house going to be worth once the renovation is completed. And that's really good for people to know too, because it gives them an idea of, okay, if I'm spending $400,000 or $500,000 on this renovation, is that money well spent in improving the value of the home?
And it's important because in one of the previous episodes we were talking about getting a price from a cost estimate about what you think it's going to cost. So if up until that point, you weren't sure or the builder's priced it at something else, the bank's going to tell you what they think at that point anyway, aren't they?
They are. They are.
So that's a construction loan. Can you tell us about any other types of loans there are?
Yeah, particularly with renovating. So we've talked about if you're doing a major renovation, if you are doing a minor renovation, so think less than $100,000 and think you're not using a builder, you're actually just going to manage this process yourself. Usually it's maybe cosmetic type modifications. If we use that example again, if the house is worth $1 million let's say you had an existing home loan of 600,000, the bank would be willing to lend you up to 80%, which is 800,000. If your existing loan is 600, you then got 200,000 you can access for minor renovations. You've still got to show the affordability piece we talked about earlier, showing you can afford the repayments as they increase. But that money will then become available to you, and there's a lot more flexibility in that approach because it is a smaller renovation. You then got that money to go and spend and when you need. Obviously, as you do draw down on it, you've then got to start paying the interest.
Yes.
That accrues. So, but yeah, that is really more of a DIY approach. When it's a renovation that probably doesn't involve structural changes. That's another really important point. The bank has given you a home loan on the basis that they can take a mortgage over your house. They don't want you going and making major structural changes if there's not a builder involved. So they're happy to give you money for cosmetic, non-major structural changes. I think new carpets, new kitchen, that's fine. But if you go down knocking too many walls and they find out about it, they might not be too happy.
That you're potentially devaluing the property.
Exactly.
And
you're not a licensed builder, so they don't have a lot of comfort in that.
And that's interesting as well, because then that opens the whole door to own a builder. So, how does that work when you are if you're an owner builder, how does that work when you're trying to get mortgages?
That's a really good question. Owner builders are a little bit of a specialised area. Some banks just flat out won't lend to owner builders.
Is that right?
Yeah. High risk. They're in their eyes, they're dealing with someone who is not doing this as their day-to-day profession.
It makes sense.
Yeah. So there's a little perceived high risk, and usually. So the way they'll treat an owner builder is, again, that's probably going to be a major renovation if you're an owner builder because you're going to have contracts involved with trades. They will take that end valuation, so they'll take the higher valuation at the end, but instead of lending you 80% of the value, they'll probably pull it back to 60 because you're an owner builder.
Right.
So they want more buffer. They want more protection if it's an owner builder involved. Can be done. There's major banks that do it, but there are some that just don't do it.
Good to keep in mind, because I know that at the moment, because the cost of construction is really high, a lot of people are thinking, well, I'll just manage the trades, I'll just get owner builder, I'll just do a few things myself. So they're still thinking of spending a fair bit of money, but they're thinking as a way of trying to control those costs and take out those management fees, they're going to do it themselves. So that's really important. So your third L is about lender. So can you tell us about that one?
Certainly. This is when we get down to the nitty-gritty of working out which bank is going to be best to work with. When we do that, we have over 30 lenders on our panel. We narrow that list down to at least the top 5. We provide a recommendation of one of those lenders and a detailed explanation as to why we've recommended that bank and why we didn't choose one of the other options considered. And that takes into account lots of things. It takes into account really, most competitive interest rate is a big one, and fees, but also aligning that lender or bank with what it is you're trying to achieve. We talked about owner builder just a minute ago. It's no good going with a bank if that's not what they're going to do, and that's what you want to do. So if you're an owner builder, we would be immediately culling our list to banks that offer that finance.
And I know other things that my clients that come up in the discussion of how will you get a home is prefabricated homes, relocated homes, where you move a house from one side onto your block, different ways of getting a house that are not through the standard builder's contract. Does that affect the lender that you can choose?
It does. The biggest influence, the biggest criteria that will determine whether or not that is possible is usually the equity you've got in your home. If you want to buy a relocatable home and you've got 300,000 or 400,000, you can draw out an equity, then the bank may well be happy to let you do that because there's enough buffer anyway in the existing property as it is. What they're not going to do is they're not going to say, hey, here's 500,000 for that home you want to come and move onto your block, we'll write you a check now, go and do it. If there's not enough equity in the home and they have to try and rely on what the valuation's going to be when the home's on there. So
I was going to say, so that's fine if you're doing a renovation and you're adding a bit and using one of those structures as an extension. But if you're hypothetically some kind of first home buyer, or it's your first house and you're looking at a way of getting a cost-effective house, and that's why you're looking at modular and all those ways, are you saying that's when you're potentially going to run into a few problems?
It's going to usually be more difficult, yes, because the bank is not going to give you the money to go and buy the home if the home's not yet on the property, because they don't have it as security.
No.
But the challenge is that with those modular homes, they usually require a fairly large amount of payment up front.
Well, it's such a quick process. It's like 8 weeks. Those things are really fast.
Yeah. So you've got to have the equity in your home already to be able to access based on what it's valued as it is. So maybe it's a vacant block or it's got a really old dwelling on it.
Okay.
To be able to get that money out to go and put down the major deposit or buy the home, and then get it moved over. And then you could get it revalued once it's on the home, and get the money back out that way.
In retrospect.
Yeah.
But you'd be able, that particular length of time, you've got to tolerate that difference in value.
That's right.
Yeah.
I mean, if you put yourself in the bank's shoes, there's no security for them if they just release a whole heap of money for you to go and give to the modular home builder if it's not yet on your property.
That's right. They've got absolutely nothing, do they?
Yeah.
Wow, that's interesting. It makes sense. So, but there's a limited number of lenders. Does it limit the number of lenders who are open to doing those sorts of things?
Yeah, it does. It does. You've got to find a lender who's willing to let you access a fairly large sum of equity to be able to go and use that money to fund the new home.
So your fourth L is lodgement, and I find that's a really important area in architecture as well, because my clients will be saying, well, when do I go and get finance, or do I get pre-finance, or what drawings do I have to, when does it all happen? Before building approval, after building approval? That's the main question. So can you tell us about lodgement?
Definitely. So lodgement is really getting all the documentation together to get some sort of confirmation from the bank that, yes, they will lend you X for what you're looking to do. We would usually suggest, if someone's looking to renovate, getting a pre-approval subject to the building contract being provided. So what we're doing there is we're getting all the paperwork together around pay slips, in bank statements, ID, getting all those things the banks are going to need, submitting it, asking them for a conditional approval or pre-approval, essentially means the same thing, which is valid for 90 days, giving us that confirmation of that amount, and then moving forward with the build contract and finalising those plans.
Yeah.
Once we've done that, we then come back to the bank and say, here's my build contract, here's my plans and specifications. That's then enough for them to go and get a valuation done. Once they've done that, they can finalise and formalise your approval.
Okay, so you have got all you've really committed to it. That's why pre-approval is important, I suppose, because by the time you get that far, you've really committed to it, you're on the way, and you really need to know whether you can borrow the money sort of beforehand, really, don't you? Because otherwise it's too late. You've had everything done and you've spent everything and got your approval. So you want to be confident that you're going to get that money when it's just a formality.
Yeah, 100%. And a lot of people will say to us, well, how do I get pre-approval if I haven't yet got a price from the builder? And our response would be, we just need a ballpark. Use the ceiling, use whatever you're comfortable in spending, but towards the upper limit, because it's easier to come down than to try and go back up. So we usually using a ballpark figure at that point, and then we're getting the build contract, the plans and specifications. We then usually got a final price. That's when we can adjust the approval and go, hey, well, actually, it's a little bit less than what we were approved for. Let's drop that down to what we need, get the valuation done and get it formalised. But, yeah, just starting off with a ballpark is incredibly important.
Yes. When's it ever less than what you need?
I know, not when it's renovating.
All right.
Yeah, and the other point too, I'd say maybe I'm going a bit off topic here, but don't go overboard with the approval part, because I wouldn't want to get pre-approved for several $100,000 more than I need or than I think I need. Only because, as humans, we probably have a tendency to find ways to spend it if we have it,
totally.
most of us. So, I might get shouted down for saying this, but try to be a little bit, have some barriers in place as to how high you do go with your pre-approval.
Yeah, I agree.
You're going to be carrying that debt for a long time.
That's right.
30 years.
And and I do think there does need to be a contingency in there. And, I talk about, design creep and all those things, and inflation and things that go up over time from the point where you talk about pre-approval to the actual point where you get the finance. But absolutely, you don't. If you can do it with less, do it with less, because you don't want to be shackled into a higher amount. And then moving on to the final L, the life of the loan. Can you tell us how you can help with the life of the loan?
Definitely. So a big part of our business is reviewing customers' interest rates on an ongoing basis. We try to do that at least annually. And the reason we focused on that is over time, your mortgage interest rate is something that a lot of people just will forget about and not pay much attention to. But the reality is if you can be going back to your existing bank and asking them for an improvement on your interest rate at least once a year, you could be saving, in some cases, a couple of $100 a month. And that really adds up over a 30-year mortgage. The other thing we're doing is we're contacting our customers and saying, look, you were approved originally at this interest rate, and at the time it was really competitive. Things have now changed. There's other lenders offering more competitive products. We think you should look at it. This is how it compares. So, it's just keeping on top of it regularly.
So moving on to my final questions and looking forward. So thinking about getting started, for anyone planning to renovate or build a new house, when is the best time to approach a mortgage broker to get that pre-approval on the ballpark of how much they can borrow?
If it was me, I would do it in 2 stages. I'd approach a mortgage broker for an initial chat to see if it's possible.
Yeah, to see if there's, what you're looking at.
I would do that 6 months before I was wanting to renovate.
Yeah.
I would do that 6 months before. I would then get the pre-approval done approximately 2 to 3 months before an anticipated start date.
So when you say an anticipated start date, that's a start date for construction on site.
Yeah.
So that's actually quite a long way down the track. So when I think about a typical architectural project, which is quite large, over 800,000, say, that whole project from the first call to the architect to the end of the job, might be 18 months. So, there's months and months in there. So pre-approval's happening well and truly through the job for larger jobs.
I would. Well, the reason I say that is a pre-approval does have an expiry date. They expire after 90 days.
That's important.
So if you're doing it 6 months out, it's going to expire after 3 months. And then all of a sudden you get to construction, it's not valid anymore. You've got to start it all again. So that's why I suggest breaking it down over, call it 2 appointments with your mortgage broker. The first one, just an initial chat, a bit of a fact find. Hey, is this going to be possible? What's it going to cost in repayments with the ballpark figure we're working towards? Okay, great. That happens, let's say, in April. And then let's say you thought construction was going to commence in October. I'd be saying, well, let's start the pre-approval process in August so that it lines up with when we're looking to actually start construction and require funds.
Yeah, because if you've got town planning approval in there, that itself may end up taking 3 months. Building approval these days takes a couple of months if there's build over sewer or there's more complex things in there. So I suppose almost in a way, sometimes it might just be checking in with your mortgage broker about that first amount before you even go through the more pre-approval is a bit more formal, isn't it? You need a bit more information for that. So it's really just having a chat about how things are changing and just touching in if the job's dragging out, which it does tend to do.
If it drags out, and then obviously you want to really keep your mortgage broker up to date if prices start to increase.
Yes.
And the loan that you're going to need is going to start to increase.
Yes, as you start to get more information about what you're doing and the costs of, when you get your cost estimator's estimate and they're saying, well, it's more like this, and then talking to your mortgage broker about how that's going to go. Would that be, I mean, really to work with your mortgage broker and get that advice so there's no surprises?
Definitely. I think keeping your mortgage broker abreast with what you're expecting costs to be and keeping them up to date as that changes.
Yeah, that's fantastic, because I know that nobody does that, and it just would take all that stress away, I think, because you know that you're on track to get it at the end and you wouldn't be trying to juggle everything. You can just, stay in contact. And
yeah, I think, when you think about renovating, I know you're really big on this, Stephanie, you want to build your team.
Yes.
And I think you want your mortgage broker in your team.
Yeah, that's interesting.
Because they're going to be helping you with the funding.
Yes.
And that's critical.
Yeah, absolutely. Okay, so I've got another question then. So we've talked about organising everything to get the finance. So I've got all the paperwork done and I've organised my loan. When do I start paying it back, and how does that all work?
Great question. With construction loans, so if we think major renovation, you need to start making repayments as the bank is paying out to the builder.
Okay.
Now, I just want to bring up a really important point here if I can. When it comes to signing the building contract, at that point, we're going to be usually finalising the approval, getting the valuation done.
Yeah.
The builder's usually going to also ask you for a 5% deposit.
That's right. That is the first step.
If you're doing a construction loan, usually the bank is not going to be able to release funds for that 5% deposit at that point. The reason is they'll usually want potentially plans to be council approved. It's a major renovation and they're still working through the approval.
That's right, because you're trying to lock the builder in because you're trying to get into his timeline. So you've locked him in and then suddenly this deposit invoice comes through. That's right, but everything else is still being lined up and you may not, at the point of signing a contract, in this market at the moment, it may be 3 months till you're actually going to start on site.
Yeah, so you may need to find another way to cover that 5%. That could be savings. It could be drawing out your existing equity. So it could be a smaller separate loan just to get that 5% covered. But just keep in mind, if you're doing a construction loan where it's progress payments to the builder, that usually can't cover the 5% deposit given when the 5% deposit is due. But going back to what you originally asked me, which was how your payments work, if I've got a $500,000 loan, that's going to be progressively paid out to the builder over 5 stages. We covered that. As that's paid out, the interest is then charged to you during that month for the amount of money the bank has paid out. So initially, the repayments are going to be small because there's not going to be a lot paid out at the first stage. It might be a 10% invoice of the total amount. But as you move through, you're going to see your repayments start to increase as the project gets closer to completion, to which point you come to the end and then, you're going to be paying it all back. During construction, in most instances, you're only covering the interest. So on a construction loan, the banks are a little understanding, some might say, and they only charge you interest. They don't necessarily require you to start paying back principal until the renovation is complete, the construction loan is finalised, and you then move to a normal home loan over 30 years and start paying it back.
And is that a given, or is that something you have to organise when you're going through all the paperwork, or is that?
That's how construction loans usually work with most lenders.
Okay.
Now, one other thing too to note is we talked about invoices. So the process usually is builder will send you an invoice, you sign it to say you're happy with it, you then send it to the bank pays the builder. On the final invoice, often they're going to send out a valuer, not to value the property, but to check all the work has been done before they release that final payment to the builder. So just keep that in mind.
And that's a tricky one, and that's probably not about, this question's not really about a mortgage broker. That final payment is often a little bit fraught because often they ask for final payment when there's still defects to be done.
Yeah. So what we've had in the past is clients will go to the branch, pick up a cheque, go to the meeting with the builder where it's the final inspection, handover.
Yeah.
And, you've got the cheque, so you can hold on to it if there are things there that are significant and that
Yes.
you're not happy with. So the bank's very much wanting you to be in control of releasing the funds. And yeah, I would take full advantage of that and manage that process by, rather than having the payments EFT to the builder and then doing your final check, picking up a bank check or getting that payment made after you've done your walkthrough and you're happy.
And so that bank check option, that's really only for the last payment, because otherwise the rest of them are going to be direct from the bank to the builder.
Yeah, correct. The bank may still send out a valuer at various points throughout the construction or throughout the renovation just to check that work's been done.
Wow, that's interesting. I didn't know that. And I suppose that, when they're getting valuers, that potentially would kick in for all levels of construction, or is that more the bigger projects?
Most construction loans it will kick in for. Each bank will be a little bit different as to when they send out valuers. Some will send out a valuer at every stage, particularly if it's a large build. Some may only send out a valuer initially and then maybe partway through and then once at the end. So it depends on the project and depends on the bank.
So what information do people who are planning to approach a mortgage broker with a renovation or a new build, what information do they have to get ready to get the best value out of that discussion about finance? And I suppose there's two instances where they're going to talk to you. There's three instances in total, isn't there? There's just the initial discussion where they're just sort of fielding how much they can borrow to set the design brief, to set that budget right at the beginning of the project. The second time is the pre-approval finance, which is a little bit more formal. And then the third time, that's really the clarification of all the detail. That's when they've got full approval drawings, all the drafted drawings, engineering, everything's ready to go. So that's down the track when you assume you've got everything in place already. So my question then is, what information do they need to have ready to show you for that initial approval, that casual discussion, and then the pre-approval?
So the initial discussion, I would suggest having your pay slips on hand, or if you're self-employed or you're a business owner, having your tax returns with you, because you might earn or you might have a vague understanding of what your earnings are, but you really want your mortgage broker to have a look across that, because they're going to look at it the way that the bank's going to look at it and calculate it accordingly. So if you're doing a heap of overtime, for example, the banks only take 80% of that income.
Right.
Yeah. So because in their view, it's not as consistent as your regular pay. So it's really important to have your income documentation with you. With regards to all your loans and liabilities, you probably don't need to get all that paperwork together at that stage, but you need to be aware of what the numbers are, what you owe on your mortgage and any other loans you've got, and what your repayments are. That's really important. As far as what your house is valued at, I don't think you need to know that at that point. Usually the brokers have so much data and software at their fingertips now. Most can just do an online valuation from their office to get a ballpark figure of what your home is valued at, which is really important if you're doing the minor renovation option and you need to access equity, because what your house is valued at will determine how much equity there is to access, how much money you can borrow. Moving on to the pre-approval,
yes,
you're going to need formal documentation. Your broker's going to give you a really specific list of what's needed: ID, income documentation, and bank statements are the main parts. That would be required at pre-approval. And then finalising your approval, it's just the documentation from the builder. So think building contract, plan, specifications, approvals.
Yes, that's right. So when you're thinking of finding a mortgage broker, do you have to find one who's local, or can you deal with other capital cities or regional areas or different places around Australia? Say if they know someone in Brisbane, if you're investment property or if you're looking to move, or how does that work?
It's a great question. You definitely can search Australia-wide for a mortgage broker. I don't think they need to be local, particularly now since COVID. 90% of our appointments are done via video. Before COVID, most of them were in person. So we just find now that people find it so much more convenient to meet via video, and actually the couple, if there's two people, they don't need to be in the same place. They can be in different locations as can the mortgage broker. So the mortgage broker can be based anywhere. However, some people we find just do like to deal with someone who they know is local. There's just I don't know, something in that. Maybe it's a little bit like your accountant. You have a bit of a more comfortable feeling if he's not too far, he or she's not too far away. But yeah, definitely as far as managing the process, the broker can be based anywhere in Australia. You just got to obviously be mindful of time zones.
That's right, because mainly banks are all national anyway, so you're dealing with the same banks, aren't you?
That's right. There's no problem for Commonwealth Bank, for example, to provide finance for a property in Perth that's been arranged by a mortgage broker in Brisbane.
Yeah.
For example.
Okay, that is fantastic. Thank you so much, Richard Jefferies, for joining me. That was absolutely really informative.
Thanks for having me, Stephanie.
These are the key points from this episode. Such a great interview with Richard. There are so many key points from today that it's hard to narrow down 3, but I'll start with these. There are a number of loan types that can be accessed depending on your personal financial situation and your construction project specifics. Also, depending on your situation, you may be able to access finance for the design stage consultants as well as the construction. As a basic guide, the standard loan types are a construction loan, which is for projects over about $150,000, where you've got a licensed builder and the payments are made over the standard stages in a construction contract. The alternative is smaller renovation loans for more cosmetic work under about the $100,000 mark. This is for bathrooms, kitchens, that sort of thing, where you don't necessarily have to have a licensed builder. You can manage the process yourself, and the amount of money will be paid out in a lump sum. The second point is that some projects will require specialised loans and there'll be limited lenders available. Typical examples of this are when you're going to be an owner-builder for a very large project of a size potentially that would have normally been covered by a typical construction loan. Also, if you're looking for finance for a relocated home, modular home, prefabricated home, things like that. The reason that these types of loans are specialised is because they're not very appealing to banks because there's a lot more risk involved. And the third point, if you need finance, it's essential to get in touch with a mortgage broker at 3 key stages. The first stage is the very initial discussion before you've started any design. You need to find out what your budget is so it can guide your design brief. The next stage is pre-approval finance, when you've got some draft floor plans and you've got more of an idea of what you want to do. Be aware that pre-approval finance is only valid for 90 days. And the final step, obviously, is that final approval stage, when you've got all of your information together and you've got your building approval in place. It's important to note that you really should think of your mortgage broker as part of your consultant team. You need to keep them up to date as the project progresses and make sure they're aware of any budget changes that may affect the amount of money that you need to borrow. Next week, you'll find out what's happening with home loans in 2024 and 2025. I'll be talking again to Richard Jefferies from Newbridge Home Loans. Looking for more information on design, construction, costs, or environment? You can find everything you need on the Renovation Collaborative website. Listen to the full podcast or get the transcript PDF edited into clear Q&A. If you're short on time, sign up for the weekly wrap newsletter and get the concise podcast summary delivered straight to your inbox. You'll also find 11 easy-to-read courses demystifying the entire home design and construction process.